In this week's update, US indices at the crossroads and looking challenged. Chile decision, the beginning of the end for South American resources. And gold pummeled again. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. All right, let's start with a market perspective. The US indices, to my mind, are starting to lose momentum. It's nothing that you can really point out and feel confident about, but there's certainly a loss of momentum in several respects. In particular, the market breadth is falling. We're seeing more small caps and mid caps turning down, and so are the upside volumes. Now, it's not dramatic, but it might just be the first indicator. So just be aware that sort of dynamic is starting to unfold. And we're seeing some divergences as well with this. So all in all, it might amount to not a great deal, but then again, it could be the start of another decline. Is it a concern? Well, look, almost no one trades the index as such, but it does impact sentiment if indices go down, and stocks that would otherwise be fairly buoyant, fairly good value, can be sold off on short-term sentiment. So that's the consideration. So what can we do about that? What can we control? Well, we just need to be sharper with our plan, clearer with our plan, better at execution, and as much as possible, just try and make time the variable. Now, what I mean by that is that the upside potential in the stock price is almost a given. It's just a matter of when. Might be next week, next month, or next year. But as much as possible, if you can make time the variable and do everything else, controlling everything else as much as you can, buy great stocks, buy at good valuations, buy them when they're technically attractive, then that's as much as we can do. Just control what we can control. American stocks, the S&P was flat across the week, but the data points economically are certainly pointing to a slowing economy. Beg pardon. There's not much question about that, and there shouldn't be any surprise there because the bond market has been pointing to recession now for the best part of a year. So it'd probably be quite unusual if the US does not slip into recession, and if the Fed goes ahead in May and raises another 0.25%, then I think it's almost a given. There's also been a few disappointing earnings come through, and I'm not sure that those level of earnings reductions have been priced into many stocks. And to just complicate what was a fairly confusing picture, it was options expiry week, and that can always throw up price actions in the very short term that are actually meaningless. They're just a bit of market manipulation that don't indicate a change in trend. US dollar index ended up being steady for the week, just below 102. The 10-year yield edged up a bit to 3.58. The VIX was lower at 16.8, and the 10-year, 2-year spread is still hanging around this 0.5, 0.6 negative mark, as it has been for quite some period of time. So let's jump in, pardon me, and have a look at the charts. This is the S&P. You can see net, we just didn't go anywhere. And if you look at the candles, the candle bodies themselves are getting smaller. A lot of indecision. We're opening and closing around about the same level. It's just really not going anywhere. And we're sitting up at this really important, what is now a triple top area around 4180. So could we come back down again, down into this area here, or perhaps even down here? Yeah, absolutely. That's at the index level. So that's the possibilities. Now, if we look at the important spread charts to tell us where the money flows are going, this is the US large cap growth versus large cap value on a weekly chart. We had a steep sell-off from November 2021 to December 2022. This year has been a strong rebound, but we've only really just come back up to the breakdown level on this ratio. So it's possible that this could turn back down again, but that's only a possibility at this stage. at the moment, you've got to say the short-term momentum and the medium-term momentum remains to the upside, but it certainly bears watching. Nasdaq versus the S&P, it's come off a little bit, but look, you'd expect that. It just can't keep rising the way that it was, so a little bit of a pause in that ratio. The market has gone a little bit defensive, as we'll see. So you can see here over the last 3 months, XLK and XLC, two of the aggressive sectors, are still leading the way, but they're pointing down. And we've got XLP, which is consumer staples, so very much defensive, pointing up quite strongly. So it's trending quite strongly. So the market is going a bit defensive. Now XLY, I think the relevance of it is sort of getting lost now because it's so heavily dominated by Amazon, which is going up and broke out on Friday, and Tesla, which is getting pummeled because of their results. So XLY for me has become, it was a really important indicator at the end of 2021 because it really did signal the change in direction in the market. But I think right at the moment I'm not placing quite as much emphasis on that. XLV in healthcare also turning up. So they're some of the major sectors. 1,000 growth versus 1,000 value on a daily chart. It's pretty much saying what the weekly one did. And this is the small caps. Small caps, we're not seeing any real bias here between growth and value. It's just really sliding sideways at the moment. All right, moving on to the Australian market. The Australian dollar down to 66.2. Plunged a bit on Friday, I guess because commodity prices went down, even though the US dollar was pretty stable. Our index was down 0.4% across the week, and a lot of that was in materials. And a good part of that is that China, that's been manipulating commodity markets for years and years and years, has made recent moves in lithium, obviously, that everybody knows about, and rare earths, but has also now stuck the pin in the iron ore prices as well. So that certainly impacted our iron ore majors, and they have a significant impact on our index. So that's the Australian market. Let's just have a quick look at that. Before I do that, let's just look at the currencies. US dollar index, you'd have to say the medium term, the US dollar index is heading back down again. And if this breaks here around about 100, then that's obviously going to be very good for commodity prices, and in particular for gold. And the Australian dollar certainly did drop on Friday. Now turning to the ASX 200, down a little bit, as you can see, nothing major, candles all pretty small, so the market really doesn't know which way to go at the moment. But it was materials on Thursday and Friday that did bear the brunt of the selling. All right, let's go to precious metals. This is gold on a weekly. We've ducked back down under $2,000 an ounce. So it's finding it a bit hard to get through this level, but I guess you've got to expect that. There's a real tussle going on. With the price down on Friday, most of it was straight out selling. It wasn't the US dollar impact, so that was sort of fairly insightful, I thought. And this is it on a daily chart, but you can see a lot of fluctuation. At one stage on Friday, gold was trading up at 2037 and then finished down at 1983, so it got hit quite hard. Now, whether that is got something to do with options expiry, it's possible. There's so many interrelationships and cross currents there that you can never be sure. So I think for the moment, I'll just let the jury decide on that. Give it a few more days once we get past the end of options expiry and the effects. Silver is outperforming gold at the moment and is looking pretty buoyant, actually. So that's the precious metals market, down $21. And when we translate that into Australian dollars, we've just dipped again under 3,000, but that's still extremely profitable territory for Australian gold miners. And when we look at the precious metal stocks, there's been a modest pullback in GDXJ which is your global stocks, and includes stocks like Northern Star and Evolution Mining. But the strong momentum in the gold sector remains locally. But as always, my preference for several years now has not been for the producers, it's been for the emerging producers that have got X factor in a tier one environment. It's just all about what can you do to de-risk your investment. Other commodities, copper was down just a tick under $4. Nickel also dipped just under 11. And again, it's really just recession fears taking over again. Crude oil dipped from around 82 down to 78. Turning to lithium, there's plenty happening in lithium at the moment. We've got a massive M&A around the world at big premiums. And that makes a statement. You know, it really does. When you step back and think about why would these companies that would know better than anybody what the real environment is in the lithium market, far more so than, you know, desk jockey analysts that are pontificating about supply and demand, why would the majors be making these huge offers at big premiums if they weren't totally confident about the future that was unfolding for lithium? It just defies logic. Now, I know that it's happened in the past where companies have made acquisitions at the top of the cycle, but I think we're in a different cycle now. We're a different type of cycle now where the demand is not going to go away. You know, the decarbonisation, energy transition theme is going to make it different, I believe, for many commodities than what we've ever seen in the past, because demand went up and demand went down. But now we've got something where the demand is not going to go down. It's just going to keep increasing. Governments are just too committed to this process now. And indeed, the community is too committed to the process. So I think that makes a really big statement about the outlook. So this is a time when you really want to put your contrarian hat on, because prices are being really pressured at a time when the outlook is just getting stronger and stronger. So, you know, valuations have now become much more attractive. I think the sell-off with lithium producers has been totally overdone. Doesn't mean the prices can't go down further for a bit longer, but I think we're pretty close to the bottom, and I think we're pretty close to the bottom in time as well. So massive contrarian opportunity. Now, the only overrider that's now come up in the last day or so is that Chile is now effectively going to nationalise their lithium industry. You know, Peru has been making noises about similar things for some time now. So I think the whole, or maybe not the whole, we'll leave Argentina out of it at the moment, but certainly Chile, Peru are areas that you've got an element of sovereign risk now that I just don't think we need. And we've got so many alternatives, you know, in copper, in lithium, in rare earths. You've got so many alternatives in Australia, the US and Canada that why go anywhere else? You know, to me, it just doesn't make sense. You've now got a big risk element, so just avoid it. So I think that's probably the huge development of the week. And it's going to be to the detriment of these countries. Now, I sort of get on one hand why they're doing it, but the reality is they can't nationalise their industry and expect the investment required and the skills expertise required to keep that industry running. So efficiency and scale is going to suffer. All right, so when it comes to lithium, you can either allow yourself to get derailed by focusing on the short-term price or the short-term price declines. And it's easy to do. We get caught in the moment, prices go down week after week, month after month, and it just wears on you. You know, I understand that. But you can look over the short-term horizon to where prices are going to be next year and 2 and 3 and 5 years out from here. And it's going to be very buoyant. And if you look at, just for one example, UBS targets for the lithium majors are well above current levels. in some cases 30, 40, 50% above current levels for the major producers. Now, that doesn't mean that the prices will go there. Investment analysts get it wrong in both directions constantly, but it's just a bit of an indication about the value that certainly is there in the lithium majors. And if you look at the Alchem quarterly, that really confirms it. The buoyancy and the valuation of these stocks. So, I remain as enthused as ever around the lithium space. There's the spot copper chart. Came off a little bit to just under 4, and there's the nickel chart also. Wrapping it up, I think you just got to find ways to try and lower the risk is the key message I'd like to project this week. You want to look for stock. Obviously, stock selection is absolutely critical. You want to look for earnings that are almost a given, earnings growth, almost a given. Valuations at historical lows. Make sure that your technical entry is at a point of oversold, so that the sellers are pretty much done and you're down to a very likely reversal. And then look for that reversal confirmation. So just de-risk as much as possible. And of course, we've all got our favourite stocks, the stocks that we want to own, just don't chase the prices. In this sort of environment, if you miss it today, there's every chance you're going to get it next week, because this is a pretty nervous market. Compartmentalise is something that I've been talking about with members, and we do a lot of this in the Insiders Club and Portfolio Analyst about just how can we de-risk, how can we position size so that we can deal with the volatility that is possible. Portfolio Analyst last week, it was about managing short-term fluctuations. And also I looked at the graphite market and presented some of the key elements of my watch list on graphite. All right, that's it for this week. There's more information on the website. There's my email address. I'll be back with you next Sunday. Cheers.